Hello and good morning to all of you. This is Professor Ramana. We had few months back we had discussed some important issues relating to financial statement analysis. The issues that we had covered during those 4 days were as follows: cash flows, cash flow from operation, cash flow from financing, and cash flow from investment decisions. Free cash flows for the firm. Then we went into the details of the performance indicators, financial performance indicators, and under that, economic value added, return on capital employed, return on equity, earnings per share. Then we discussed the process of calculating the Altman Z-score and also touched upon the treatment of foreign currency transactions. I would like to recap some of these issues before we get into the other aspects which we had not covered in those 4 days. On the day 1, we started by asking this question, why the financial statement analysis? And we saw that some of you answered and said in detail that financial statement analysis is required for the equity investors, for the bankers, for the rating agencies, grading agencies, and for management. For equity investors, both existing and the potential, to determine the value of the firm, to determine the changes in the price of the share, to determine the profit that one can make by purchasing or selling the shares. For bankers, they would be interested in understanding the liquidity position, the solvency position, and the possibilities of bankruptcy. For management, to determine the employees' compensation and also use the financial statement as an input for day-to-day managerial decision making. And how will they use this financial statement? By undertaking the inter-firm comparison and intra-firm comparisons. What to compare? We saw that the financial statements can actually throw light on the liquidity position, the solvency position, the profitability position. The liquidity is the ability to meet the short-term obligations. Solvency is the ability to meet the long-term obligations. Profitability is the ability to generate profit, or profitability is the ability to distribute profit. The financial statements will also help in determining the possibilities of a firm becoming bankrupt, and that was possible by calculating the Z-score. And financial statement will also help in determining the value of the firm. So therefore, one can compare the bank Z-score, one can compare the value of the firms, one can compare the profitability, solvency, and liquidity positions across the firms or of a particular firm over a period of time. And the input for these analysis are the financial statements, balance sheet, income statement, cash flow statement, and these are statutory and GAAP driven. But the focus of our day 1 class was actually to understand the interrelationship between these 3 financial statements. I mentioned that the change in 2 balance sheets can be explained by their cash flow statement and income statement. That means 2 items on a balance sheet changes. The changes in that item can be explained by observing the balance income statement and the cash flow statement. So we then went into asking this question, why is cash in hand is not same as profit? We saw that cash in hand is a receipts minus payment, whereas the profit is incomes minus expenses, and all receipts are not incomes and all payments are not expenses. Therefore, cash is not equal to profits. Then we got into the details of this question, why is the cash from operation not same as profit? But before we answered that question, we got into the details of preparation of the cash flow statement using the International Accounting Standard 7. And we saw that the CFO is a receipts from operation minus the payments from operation by using the direct method, and the CFO can be positive CFO or a negative CFO. The CFI is the cash from investment activities, so purchase and sale of fixed assets and investments. So the receipts from the sale of fixed assets and investments, the dividend received, interest received over the payments for purchases of fixed assets and investment. So CFI can also be positive or negative. CFF relates to the sources of finance. Here also the receipts from the issue of capital or bonds less the payments towards the financing decision, that is the repayment of capital, the repayment of loan, redemption of preference share or buyback of shares or distribution of dividend. The CFF can also be positive or negative. That led us to this question, why is CFO not same as PAT? We discussed that CFO is not same as PAT because of three reasons, mainly the non-cash items like depreciation, amortization, non-operating items like interest received, interest paid, dividend received, dividend paid, and profits from the sale of investments, and the credit items like the credit sales, credit expenses, credit purchases, advances paid, which is called the changes in the operating non-cash working capital. So therefore, we came to this particular relationship. We said that CFO is adjusted PAT, adjusted for non-cash items, non-operating items, and working capital changes. On day 2, we got into the details of cash flow statements once again and focused attention on free cash flows. And the free cash flow is a non-GAAP number. Firms are not required to show free cash flows on the balance sheet or in the cash flow, but one can determine the free cash flows by seeing the financial statements. Free cash flow is used for managerial decisions like capital budgeting, valuations of the project, valuation of the firm, and the valuation of equity. The free cash flows are of two types: free cash flows for the firm or the firm free cash flows FFCF, or equity free cash flows EFCF. Free cash flows for the firm is used to calculate the value of the firm or the project, and the free cash flows for equity is used to calculate the value of the equity. The free cash flows for the firm, we discussed in detail about the process of calculating, and we saw that it can be calculated or determined by using sales or EBIT or PAT or CFO. And one of the formulas that we used during those classes is free cash flows for the firm is PAT plus interest into 1 minus T plus depreciation plus amortization minus the increase in working capital minus the capex. So free cash flows for the firm can be determined by PAT or PBIT or sales or CFO. On day 3, we had a detailed discussion on the performance indicators, and under the performance indicators we classified the GAAP driven and non-GAAP driven, and the GAAP driven are the profitability, solvency, liquidity, and under the profitability we saw return on investments and variations of return on investment. And we discussed that GAAP driven accounting performance indicators have some limitations, and these limitations are financing anomaly because it ignores the cost of equity, and the accounting anomaly which says that the profit is subject to the accounting assumptions. There are several items on the financial statements which are subject to the accounting policies. Some of the common popular items which we often see on the financial statements are the cost of goods sold, depreciation, amortization, revenue recognition, leases. So non-GAAP performance indicators, some of them are free cash flows for the firm, economic value added, the market value added, and enterprise value. Then we discussed in detail, spent a lot of time on calculating the economic value added. The economic value added is the excess of NOPAT, net operating profit after tax but before interest, over the capital charge. And capital charge recognizes the charge for both debt and equity. EVA therefore is expected to address the financing anomalies and the accounting anomaly. It addresses the financing anomaly by bringing in the cost of equity and addresses the accounting anomalies by bringing in the market value into this determination of EVA. And EVA therefore is equal to NOPAT minus the capital charge. And NOPAT is an adjusted PAT, adjusted for interest. So therefore this is called profit of an unlevered firm. And the capital employed for the determination of capital charge is equal to equity plus long-term debt plus interest-bearing current liabilities. In other words, it is capital employed for EVA calculation is the total assets minus the non-interest bearing current liabilities, NIBCL. You see this, IBCL is the interest bearing current liabilities and NIBCL is a non-interest bearing current liabilities. And weighted average cost of capital depends on the cost of equity, cost of debt, and the debt equity ratio. So we use this formula to calculate and determine the economic value added of several examples, and we observed that the EVA can be managed by managing NOPAT or managing WACC or managing capital employed. In other words, the EVA can be managed by managing the operating decisions, investment decisions, and financing decisions. On day 4, besides discussing the Z score, we spend a significant amount of time on understanding the treatment of foreign currency transactions. So the relevant accounting standard IAS 21 talks about reporting currency, functional currency, and foreign currency. Every company is bound to report their transactions in the reporting currency. So all the foreign currency transactions are to be converted into reporting currency. So therefore issues for discussion were the initial recognition of the foreign currency transactions, the subsequent recognitions of the items recorded in the foreign currency, and the treatment of the gains and the losses arising out of the fluctuations of the currency. The initial recognition, the accounting standard says, the transactions have to be recorded and reported in the reporting currency using the spot rate on the date of transaction. So every transaction has to be converted into the reporting currency by using the spot rate. The subsequent transaction, the treatment depends on the financial items, and the classifications are monetary items and non-monetary items. The monetary items are the items like loans, creditors, debtors, lease payable, and the non-monetary items are stock, plant, shares, building, computers. These are all non-monetary items. According to the standard, all monetary items are to be revised and to reflect the spot rate on the balance sheet date. So the items appearing in the initial recognition will be different from what will be the new value shown at the subsequent balance sheet. And all the non-monetary items continue to appear at the historical cost. The accounting standard says all the gains and losses arising from the currency fluctuations to be transferred or to be shown in the income statement as a loss or the gain. So therefore, in the first 4 days, we touched upon some of the important items which affect the financial statement analysis, that is cash flows, the free cash flows for the firm, the economic value added, Altman Z-score, and the treatment of the currency transaction. The issues which are left for us now to take up: the revenue recognition. We'll try to understand the process of revenue recognition by taking an example or a case study. We'll understand the concept of the deferred tax. Till now we used to calculate the tax on the book profit. And we'll see how deferred tax is not same as the current tax. And then one of the important issues that we are going to understand and discuss is the accounting for financial instruments. But however, the next leg of our session will start with a quiz, and the quiz will in which you are required to prepare the financial statements and also show some of the relevant ratios, and it will be a group quiz. Thank you.